Time, so I'm gonna kick this off. I'm Elena Falsatoni. I'm a senior economist in RBOBs here at the board, but most of you know me as the annoying person who's been emailing you for the last few months, but still me. So before we actually kick off with the main event, I'm gonna have a few housekeeping items for you to know about during these 2 days. So the first thing that you probably noticed is that we have live streaming throughout. So do not be intimidated by the cameras, but do remember that you are being watched in case you want to adapt your what you say accordingly. On top of that, we will have a photographer going around now as well as throughout the 2 days, in and out. Do not be freaked out. I'm sure you look fantastic on camera. We do not provide makeup services. Now you all have a mic for each 2 people in front of you. Whenever you want to make, ask a question or make an intervention, you need to turn it on. There is a speaker button that you need to click. Do remember to click it, or the people that watch the live streaming will not hear you. We also have a portable mic that we will use for any questions if your mic does not work, but generally it should all be fine. For the presenters, you will have to speak at the podium mic for the live streaming. And then finally, if you have not received it yet, but you need Wi-Fi, we do create Wi-Fi accounts for everybody here, and Kim and Courtney, the 2 fabulous people, together with Ken at the desk in front of the room, will be able to give it to you. Now for the presenters, if you do have any changes in your slides, Karen in the back over there, a fantastic analyst in RBOBs who's been dealing with me and this conference for the past few months, will be able to help you. All right, with that, the housekeeping items are done, and so I am extremely happy to see you all here at the 12th edition of the Economics of Payments Conference. It is so great to see familiar as well as new crowds all over here. And here to open the conference is Governor Chris Waller. Governor Waller took office at the board in 2020 after serving as an executive vice president and the director of research at the Federal Reserve Bank of St. Louis for 11 years. And prior to his career in the Federal Reserve System, Governor Waller held a number of academic positions, most recently with the University of Notre Dame. So please join me in welcoming Governor Waller to the podium.
Well, thanks, Elena, for that. I appreciate it. So before I get started, I just wanted to make a quick note that I was talking with Kim Hoon. It's nice to see friends at these things again. I was talking to Kim Hoon, and he reminded me that this conference was started by Ed Green, I think 11 years ago, or approximately, and Ed passed away in 2019. So despite his passing, his legacy continues on with the conference. So it's a pleasure to welcome you all to this annual conference hosted by the board for the first time in more than a decade. The payment system is changing, and the agenda for the next 2 days indicates that this year's conference will tackle a number of topics that are central to this evolution. The Fed plays multiple important roles in the payment system. We provide key services directly to a broad set of commercial banks, credit unions, and to the U.S. Treasury. We maintain accounts for these entities, transfer funds electronically, collect checks, and distribute currency. We also supervise certain financial market infrastructure. Through these functions, we help to ensure that the U.S. payment system meets the needs of consumers and businesses. From its founding, the Federal Reserve played a central role in the payment system. Market disruptions that contributed to financial panics in the late 19th and early 20th centuries were an important impetus for the establishment and design of the Federal Reserve. During the panic of 1907, some banks refused to clear checks from other banks, creating a crisis in depositor confidence and leading to bank failures. Paul Warburg, an influential figure in banking at the time, argued that the central bank should have a duty to establish and maintain a perfect system of credit, enabling the general banks to transform cash credits into actual cash. Who ever heard of that? Who wants actual cash? With such absolute ease and certainty that the use of cash credit instead of actual cash will not cease, no matter what may happen. Now, in 1913, Congress did just that by creating the Federal Reserve, and assigning it the authority to establish a nationwide check clearing system. Shortly thereafter, the Fed established a wire transfer service known as FedWire, and later built on that with the Automated Clearinghouse, or ACH service, in the 1970s. With the launch of FedNow this past summer, we have an instant payment service. Our job in providing these services and carrying out our responsibilities is to make sure the payment system functions efficiently and resiliently, promoting the kind of confidence that Warburg understood was vital. It's great to see that those of you participating in this conference are taking on the key issues of the day and pushing out the frontier of knowledge with your research. And sometimes the frontier pushes back. Just yesterday, we had a board meeting to carry out our statutory responsibilities with respect to setting the debit interchange fee cap. And of course, we have an interest in the developments around other topics on your agenda, such as stablecoins and crypto. But with just a couple minutes left before the formal proceedings start, I want to draw a connection between two topics on your agenda and two questions that I have. First, how quickly will consumers and businesses demand instant payments? As I mentioned, we recently launched FedNow, our newest payment service. In some ways, what FedNow is doing is not new because it simply executes the operations that happen between when a bank sends an authorized consumer transaction and when that transaction is cleared and settled on the other end. Some of those exact things happen now with ACH, but with ACH it takes longer. FedNow speeds that process up from often a couple of days to a couple of seconds, from initiation to final receipt by consumers and businesses. The launch of FedNow was just one of many steps toward a system where substantially all payments are settled instantly. Banks also have a role in moving us closer to that reality. They will have to adapt their systems to be able to connect to FedNow. And how soon they do that will depend in part on how much their customers demand instant payments. Moving on to my second question. I see that you have a session on central bank digital currency. As many of you know my views. About 2 years ago, I posed a very simple question that any economist would ask. What is the fundamental market failure that a central bank digital currency would solve and only a CBDC could solve? I have yet to hear a convincing answer in over 2 years. As I mentioned earlier, the Fed's job is to make sure payment systems function efficiently. For over 100 years, that has meant that commercial banks and the credit unions engage directly with the consumers on the front end, while we sit in the back end and make sure things clear and settle efficiently. What then are the reasons to support why we should change our role in sitting out of the front end and now engaging directly with consumers? I haven't heard a good answer to that, but I'm happy to see that as a topic being discussed at your conference. So with that, I will step away so that you can get on with the main event. Thank you all for being here, and I hope you have a great and thought-provoking conference.
All right. Right on cue, I think with Governor Waller's remarks, we're going to have our first session on cash and cashless. And the first presenter will be Lucas Argentieri Mariani from University of Milan Bicocca, discussed by Kim Hyun. And then we'll have Andre Stenzel from the Bank of Canada, discussed by John Rust. Lucas, feel free to come here. And remember to speak at the podium mic.
So first of all, thank you all the organizers for including this paper. I think this is a fascinating topic, and I'm very happy to present our paper. So I think I do not have to say that, but just what we are presenting here does not reflect any opinions of the Brazilian Central Bank. So basically, the general context of the paper is that what we see is this recent expansion of the new financial technologies worldwide, right? And in particular, digital payments. We are here on a conference just about payment itself, right? And at the same time, we see the entry of fintechs and a transition from a branch-based banking system to a more digital banking system, right? So this paper, we are going to talk about Brazil. So in Brazil, what we saw in the last 7 years is that a reduction of 22% in the number of bank branches in Brazil. So this is a quite sizable reduction in the bank branch. So you can have a sense that Brazil is also transitioning for a more digital environment, right? So what we are going to study here is to understand how the presence of brick and mortar bank branches moderates the diffusion of payment technologies, especially new payment technologies, and how this presence of those banks hinder the penetration of fintechs by increasing the dependence of the local economy on cash. So basically, you have cash, it's very easy to get cash, you are not going to use new payments, you are not going to use fintechs just because it's easy for you to just get cash, right? And we are going to do that by investigating this new payment technology that's called PIX, which is something similar to the FedNow. And we are use this payment system implemented by the Brazilian Central Bank to shed some light on the determinants of the adoption and also the impacts of PIX on payments and also credit market competition. So you can have a sense that there is a link between bank branches and payment technologies, right? So a key function of the banks is just to provide a payment service. So they can do that just by storing and distributing currency, issuing deposits, credit and debit cards, or just clearing checks, right? But there is another way that banks can also influence the use of those technologies, right? They can use their proximity to influence if people are going to use cash or not, right? So if it's very easy for you to just go to a bank branch and get money, probably you're going to use cash much more if you just had to walk 2 hours to get cash, probably you would use another payment methods, right? So by having these bank branches, the banks, they basically lower the cost of withdrawing and depositing cash, right? So the cost of handling cash is much lower if you have a branch close to you, right? There is also a link between these bank branches and the payment technologies, right? Physical branches can reduce the locality use to use more cash. They can induce the locality to use more cash, even when new and welfare-enhancing technologies emerge, right? If there are some costs to adopt these new technologies, like if there are adoption complementarities, some coordination failures, some learning costs, or some lack of information about this new technology, any trust or organizational constraints, status quo, we can have several different explanations and costs that we can link to the fact that these bank branches, they can just induce the technology to use cash and not use this new technology that are much faster, that have lower costs, just because they are not, the cost to learn about these new technologies is much higher than just keep using cash, right? There is also a link between the cash usage and the fintech penetration, right? So digital institutions, they do not have a physical infrastructure necessary to support cash and deposit withdrawals, right? So there are some large setup costs for these fintechs. They are not going to spend a lot of money to open branches in different locations, right? They're just operate digitally, right? So basically, if you are a customer of a digital bank, what's going to happen is just that you are going to use the network of the traditional banks that have a bank branch to access cash, but this is you are just able to do that at a cost, right? So cash dependence can hinder the expansion of these digital institutions because of that, right? It's so expensive for you to use cash, to use these digital banks that you do not use it, right? So the availability of a new digital payment might foster the competition both in payments, as you are reducing the cost of the payment itself, but also this can spill over also to the credit market. So this is something that we are also going to talk about here. But the main challenge here is that you can have a sense that branch network decisions are endogenous, right? So banks might close branches in places where the population is expected to adopt digital service, right? So you just close the branch, you keep your clients just because the population is going to use the digital app and all of that. So probably it's endogenous, right? They choose the locations in which they are going to close the branches just in places in which people are going to use this digital service, right? So how we deal with that? We exploit this plausibly exogenous variation arising from banks' heists in Brazil. So basically, these bank heists in Brazil, what happens is that they use explosives. They just use the explosives to get access to all the cash stored in the branch. And these branches become temporarily unoperable. It takes some time for them to refurbish the bank branch and like keep going with the physical bank branch, right? These attacks are performed by non-local criminal organizations. They just go there, they get all the money, and they just flee away. So this is not correlated to local crime. We are going to show here that there is no correlation between these heists and homicides, for example. And they're also unlikely to coincide with other positive shocks to technological use. So, for example, one thing that could be that recently a referee told us, does the bank, does these heists are correlated to COVID? No, they're not, of course. So what we are going to do here is that we are basically employ this empirical approach. We are going to use this weekly and monthly data with event study and a matched control group in a difference setting. So just a summary of the findings here. So this sudden and temporary interruption of the bank branch service leads to a sizable reduction in branches' cash inventory for at least 3 months. No short-term effects on the stock of loans or deposits, and there are some persistent increase in the adoption and use of digital technologies. So this is the first part. On the second part, we focus on the spillovers, right? So we check what happens to the spillovers of banks that are not affected by these attacks, and we show that the unaffected bank, in particular the digital institutions, they increase both PIX provision and also credit provision. And we also have some evidence that these effects are a bit heterogeneous between individuals and firms. So just to give you like a context of the banking sector in Brazil, so for example, in 2021, the 5 largest banks accounted for more than 68% of the assets. So you can have a sense that these are quite concentrated market, right? So there are large potential gains from increasing competition, right? Brazil is also like a nice setting to study that because in Brazil, there is a large use of electronic payments. It's quite a sophisticated financial market, but cash is still a relevant payment method, right? So we have both the electronic payment methods, but also cash is still important in Brazil. So what happened is that in the November 2020, the Brazilian Central Bank introduced this new payment technology, which is similar to the FedNow. So it's available 24/7 to individual business and governments. All the large banks, they need to participate on the payment system. It's very simple, so you just require like a simple key. It could be your email, your tax ID, your phone number, or even a QR code. So you don't need to give any like details of your bank account. You just go there and say your telephone number, your ID, you can choose. It's also very cheap. It's free of charge to individuals. And the only requirement is that you need to have a bank account on a bank or a payment institution. And you need to have internet connection. That's it. So this is a picture of like a small vendor in Brazil using Pix, right? There is a QR code. You can just take your smartphone and just like scan the QR code and make the payment. Or they could also use the telephone number, like one of the keys that they can use. So Pix was a huge success, right? So in April of 2022, more than 115 million individuals, so 55% of the population, and 9 million firms have registered to use the system. Like the number of transactions is almost $2 billion. Person-to-person transactions are the most relevant ones, but it's also important like person-to-business. There is higher penetration in places with higher GDP per capita, literacy rates, share of service sector, and internet access, right? So people are really using their on places that they have the infrastructure and they are able to do that, right? It's also very important to say here that even though 55% of the people are registered to use the payment system, just like about 20% really use it on their daily lives. So they are registered there, but they're not using every day, right? Also some context on the bank robberies. So these are bank robbers that use explosives. So they use the explosives to access all the cash stored in the vault and the ATMs. These are hit and run raids. So they just go there, get all the money, and they flee the city. It happens mostly on small and medium-sized cities. It's just in the dead of night, so nobody is at the bank branch at the time of the attack. Nobody is affected on most of these attacks. Nobody is affected by that, because you can have a sense that banks have insurance for that. It's also like there is also like deposit insurance, so people are not going to be really affected by the shock, besides not having access to the cash, right? So this is like, the bank heist requires some skilled personnel, careful planning, and expensive equipment. So you can have a sense that this is just performed by very large gangs that do not operate locally, and they happen almost everywhere in the country. So for example, there is this São Paulo anti-bank robbery task force that, I don't know how they calculate that, but it seems that you need at least 10 people and more than $80,000 US to perform one of those attacks. So it's a very expensive type of thing. You cannot just get some friends and go to the bank and explode the bank branch. It's just like they are really well-organized criminal organizations. And there is no relation with trends in other crimes. So this is usually what happens to a bank branch. This is the Brazilian Central Bank, the Banco do Brasil, which is like a government-owned bank. Also what happens to a private bank, more or less the same thing. You can also see here that also the ATMs are destroyed, right? It's not that they're just destroying the bank branch, but they are also destroying all the ATMs that are inside the bank branch, which is a large source of like how people get their money, and most of the ATMs in Brazil nowadays are inside the bank branches because of security issues. So the data that we are going to use here, first what we did is that we collected information from the state police departments with complementary information from news. We have information on the date of the event, the municipality, the bank, if they use explosives or not. And we collected that for 15 states, which represent more than 90% of the Brazilian population. We just got the information from these 15 states. Unfortunately, some of them, they just said, we don't have this information, we don't want to provide this information. We complement that with branch level data. We have monthly information, balance sheet information, and we also have information on the PIX, the new instant payment method, credit, and also information about other payment methods. We have a sample restriction here. We just focus on localities, municipalities that have at most 10 branches or service stations in 2019. Why we do that? Because you can imagine that if you have a lot of bank branches there, it's going to be very easy for you to just go to another bank branch, not yours, just to get access to the money, right? So the shock needs to be really meaningful. You don't have any other branch to collect cash. We use matching, right? So if we check the unmatched sample, there are some differences between the municipalities in which the attack happens and which the attack does not happen. We use the coerce and exact match, and then we have some good matching in these observables. It's important to highlight that even the variables that we do not match, they are matched in the end. It's just that we don't have to have we don't need to have homicide rate, like the share of service value added or anything like that to get a good balance here. So we just use the first variables that we have there, and we also are able to match the other variables. So even homicide rate, which is something that we should not expect, we have the balance here. And it's also important to highlight that all the results that I'm going to show here is for the matched sample. The results for the unmatched sample are very similar. So this is our final sample. The gray municipalities are the ones in the control group, and the ones in black are the ones that are exposed to this bank rise, right? So what happens to the bank cash holdings? Nothing before, and then there is this large shock to the cash holdings at the branch level, right? This represents more or less 95% reduction in the bank branch, and even 5 months, 6 months after the attack, they still have a lower level of cash. And this happens because it does not return to the old levels, because what we are going to show next is that there is a transition to a new equilibrium with smaller cash reliance, right? And these effects are not driven by the branches being closed down. They do not close the branches. It just takes some time for them to get the branches running their normal job, right? What we have here is what happens to the PIX usage, right? What happens to the instant payment use? After the robbery, the number of transactions and the value of transactions, they increase. And it's important to highlight that they just increase in places in which you do not have an alternative bank branch. So for places that we have more than 4 branches, the effects are not, they're basically zero. So if you have other alternative branches to just withdraw cash, in these places, the effect of the robbery is basically zero, right? It does not seem that the fear to go to the bank branch that's driving the result. It's just the fact that you don't have an alternative to withdraw the cash, right? And as I mentioned before, no correlation between homicides and the robberies, no real effects. So it's just what's really happening there is just that people cannot go to the bank branch and get cash. It's not really affecting their daily lives, right? What we do next is to show what happens to the other technologies that were there before PIX. What happens is that before people were using more debit cards and a little bit less of these other methods, which are close to transfer wires, payslip. They start to use a little bit less payslip and a bit more of debit cards. After PIX, what happens is that they use much more PIX. If we compare PIX with the other methods, they're using much more PIX than the other methods. And there is also a decrease in the point estimates for the other electronic payments. So they are really, it seems that they're really using less the other electronic payments except debit cards. They still use debit card as a way to deal with the shock. We start talking about the spillover effects, right? So here are transactions that are unlikely to be performed using cash. So there are transactions that people pay suppliers in other municipalities, or they receive payments from customers in other municipalities. These are payments that are very unlikely to be performed using cash, right? But still for these payments, we see an increase both in the quantity and the number of households and firms that use PIX, right? So they're really transitioning from the other payments method to PIX, which is like a more convenient and cheap method than the other ones. So they're really transitioning to this payment, and probably they are also using less cash to do the transactions. The last part of the paper, what we are going to talk here is about the spillover effects to unaffected institutions. So we have this direct effect, what happens to the banks that were affected by the robbery, right? But what's interesting here is to see what happens to the banks that were not affected by the robbery, but they are still present, they can be still present at the locality. Are they getting like a larger market share? If they do, what type of bank gets a larger market share once the shock happens? We start by documenting that using PIX data, right? What we have here is that people start to use PIX in the affected institutions, right? They are client of the affected institutions. They cannot access cash anymore, so they need to use PIX to respond to the shock. But interestingly, we also see that these effects spill over to other banks, and especially the digital institutions. So we have some effects for private banks and state-owned banks, but we have very large and significant effects for the digital institutions. These are the institutions that maybe they were not able to enter those markets because of their reliance on cash, right? But now people are opening accounts and using their accounts on the digital institutions to perform the transaction. On the second step here, what we are going to see here is to see what happens to the credit market before and after PIX. We are trying to see here if PIX is really able to mediate the effects on the digital institutions and also on the other institutions. So we start by looking what happens to the household credit. What we show here is that basically the affected institutions, they provide more credit on the localities in which they were affected by the shock. And the digital banks provide more cash. So they're really providing more cash once you have a lower reliance on cash. And this effect is actually 3 times larger for the period after PIX. So PIX is really like lowering the dependence on cash, right? And this is also like increases the effect that we see on the digital institutions. So it really seems that PIX is mediating the effects here. Once we look to the corporate credit, what happens is that firms get more credit on the affected institutions. This makes sense, right? They need to deal with the shock, so they probably get POS machines and all of that, so need to get some credit to do that. But what we see that's very interesting here is that before PIX, the digital institutions, they would not provide more credit to corporate clients. But once we have PIX, and we have this lower reliance on cash, the effects of clients on digital institutions increase a lot. So once we have basically these 0 effects before PIX, this effect is very large, representing a 50% increase in the number of clients that they have after PIX. So it really seems that PIX is really mediating these effects on the entry of fintechs. And one question is that what happens to aggregate credit, right? It just seems here that there is a reallocation of credit. It's not that the digital institution is providing more credit, it's just that they are filling the void of the traditional banks once the shock happens. The only effect that we see here that's a bit that's significant here is that for corporate clients we see an increase in the number of clients after the robbery, after PIX happens, right? And this should be driven by this large effect that we have here on the number of corporate clients that the digital institutions have after the shock. So just to wrap up here, our paper provides some evidence that the disruptions in branches operation increase the use of financial technologies. We also show that this new financial technology known as PIX is the preferred choice after these disruptions. The increased technology use spill over to other municipalities and to non-affected large banks, fintechs, and digital banks. And finally, our results also shed some light on the fact that financial technology adoption is not homogeneous between business and non-business users. And the final thing is that it really seems that this financial technology is really affecting the competition at the local market by decreasing the levels of cash reliance locally. Thank you.
So thanks a lot for this opportunity to discuss this paper. So thanks Elena and all the Fed board colleagues to put the effort to put on this wonderful conference. So I'm going to discuss this paper. I think I had a lot of fun reading this. It's a must read for everybody, especially those thinking about faster payments system, introducing it, and what will happen to payment services. So everything I would say is my views and my views only, not the Bank of Canada or its governing council. So I think the presenter did an excellent job explaining this. I always think this is an opportunity for me, especially to learn more about spatial economics. So that's the picture of the match sample of the municipalities that have been affected by these robberies. These robberies basically reduce the availability of cash access points, and using this analysis, especially during when PIX was introduced, there was a substitution or more increased usage of PIX. So I guess I'm going to center my comments to understand these mechanisms more and try to think about these things that happen. So we know that PIX is a runaway success. Everyone talks about it. You see a lot in the media. One thing that the Bank of Brazil, the Central Bank of Brazil, did during this time before PIX was actually introduced was they introduced a 200 real note. So I work in the currency department, so we always get the updates in real time, all the new note issuance. So why is it important about the 200 real note? Well, it doubled the nominal banknote available, and then there were concerns that, well, you're increasing the value of this banknote may lead to other consequences. So I'm going to park this idea for now, just leave it for you as a trailer of some discussions on the later. So the one assumption in the paper is that the bank robbers are rational. And so I rewatched Heat again and again. I love this movie, De Niro, Pacino, and Val Kilmer. So some people may say this doesn't make sense. Are these really rational people? So fortunately, there is some research in this area using a very nice structural model and really great data by Master Bujini and Rivers in the Economic Journal. And so they set up a very Becker-type model, right? The value of crime is how much you can get versus the offset by the probability of getting caught. And so there's a lot of math in there, but at the end of the day, it comes down to this very nice equation, which is the compensating variation for a successful robber is basically the probability of getting caught in that haul minus the haul and then the time duration. And that's what they find. The time duration is really a strong predictor of whether the robbery was successful or not. So they used a sample of 5,000 robberies. They found that 6.6% of these robbers are arrested, and the haul is about 8,700 euros. So in the paper, you found that the average haul for this crew of 10 was 8,000 US dollars. Kind of lines up. So it'd be useful to use this as external validation, right? So Italian, to see a cross-country comparison, who's more efficient, or Italian robbers versus Brazilian robbers, right? Maybe we can settle on the pitch next World Cup. Okay. Okay, so not to be totally flippant about this discussion. So I just want to go back now. Now you have the, you can answer referee 2 that says these robbers are not rational. Yes, we have evidence that they are. You talk about the endogeneity of the bank branches. So the Brazilian government in 2004 launched this program, and my Portuguese is horrible, so it's Banco para Todos, or Banks for All. So in 2004, there was this push to target underbanked cities, not served, right, by having these state-owned banks. And so this is excellent paper by Fonseca and Matre. They document this. So you can see that in 2004, there was quite a bit of portions of the Brazilian municipalities without a bank branch. And then with this program, you can see that's falling, and up until 2014. So in as you can imagine, this was a very intentional policy that led to increase in financial developments on both the extensive and intensive margin, increasing financial inclusion, because now you're providing these banking services, and increasing the density of bank branches, right, and leading to financial deepening. So all the things, the latter part of your paper you have. So this is evidence that's even before that this is an intentional policy. And so remember, I'm learning how to, the map of Brazil. I'm learning Brazil much more and more. You can see here in their sample, you can see the treated municipalities versus the non-treated. So it's always very interesting when you do this coarse exact matching. You have a set of characteristics. You instead of doing nearest neighbors, which is, you kind of take it, you coarsen the covariates, and then you do matching. Maybe one thing you want to do is, I noticed that you do as a sample validation, look at bank branches in 2017. Maybe you want to just see what prehistory led to this. Check to see 2004, to see if there's any of this balancing, covariate balancing approach that you look at. It's important because in the Fonseca and Matre paper, you actually see what is the response when there's more entry of these public banks. What's the response by the private banks? And in their empirical study, they show that there's this increase in these public banks, but the response by private banks is very small. There's not that much exit. So it's always go back to this, that this is some evidence of an underserved market by the, Governor Waller mentioned something about a market failure. So there must have been some type of market failure identified in order for this policy to enact this policy. So with that in mind, what good could you do, right? That's would help us to understand this more. So your definition of everything is about a municipality, and that's your definition of a market. So one thing you could consider, and this is a very interesting, it's always these lovely papers by Mark Weissman, Robert Townsend, and Christopher Walsh. They go to Thailand, and once again, it's a similar type of scenario. There's private sector banks, government-owned banks, and Thailand's, the Townsend Thai project has been ongoing for, well, it's ended, but over many decades. And one of the things they did was they looked at what would happen with the bank branches in Thailand before and after the financial crisis. And in order to do that, they had to define markets, given that the shape of Thailand is very different, right? There's this part, and then it's like and then there's that peninsula. And so defining markets was not just about land-based or distance measures. So they came with very innovative ways to do clustering, to define a market, and even to validate this. I just love this, right? They use luminosity data to see the night lights of what defined a market. So you can see in 1992, there's that what the village was, the outlying areas, and then you see the evolution to 2019. So once again, I know referee 2 will, hopefully referee 2 is going to be kind to you that asked you to do this, but I always say that there's more papers to be written and something for you to think about going forward. So I'm going to go back to that 200 real notes. So there's the measure that was used to understand the decrease in cash withdrawals. You need to show those results was look at ATM or the number of cash withdrawals. So in your paper, you said that branches handle about 7.2% of cash withdrawals. The ATMs about 79.3%. Yes, so when there's an explosion at the bank branch, it takes out that ATM. So at least in the Canadian context, and this is where I asked the question, it's my total ignorance, but what's happening to these banks are also providing standalone ATMs. It'd be useful for you to think about that, unless these robbers are going around blowing everything up. This is a graph of notes in circulation, and I downloaded it from the Bank of Brazil, Central Bank of Brazil's website. So you can see it's from 2013 into 2023. So you can see the cyclical patterns, the seasonal patterns, and then I did some crayon econometrics. So hopefully James McKinn is not listening and chides me for this. He's my econometrics professor. But the two green lines are the sample period that the authors consider. And so there's the pre-PIX area, and I think everyone can see where the PIX was introduced, right? At that point, when PIX the notes in circulation falls. However, you would think that's, well, this is an open question for me, and I actually sent an email to the Central Bank of Brazil to understand, well, what's happening to notes in circulation? What denominations are, if we can get a breakdown of these denominations? So we know that that PIX enables transactions-based use of cash, but then there's also another very useful use of cash is just store value. So especially with the 200 real note, right? So for context, 100 real note is about $20 US, and 200 would be about $40. So for those old enough, do you remember the band The Bugles? Well, video killed the radio star. And I actually found even the Brazilian colors. So my open question is, will PIX displace cash? We don't know. This is very poor econometrics because it's just a linear trend. You can fit a polynomial of some sort. But even before, so that's kind of very reduced form, but I think it's very interesting for us to understand the underlying market forces, and this is what economics of payments is great. So thinking about movies to think about in the future, does everyone remember Live Free and Die Hard? I know you laugh, right? What was the premise of that movie? There was some cyber attack, right? So John McClane, he has to pair himself up with a computer-savvy person. So I don't know. That's my forecast now. That's there's going to be more papers about this in the future, right? So now these robbers, I always think that crime, people can change, people can learn new things. So maybe if they finish blowing up bank branches, we could start thinking about cyber attacks. And so you can see there's been media reports about cyber attacks or some type of phishing in Brazil. And so it'll be very interesting to see that type of what happens as PIX becomes more and more widespread. So just some advertising. This is how the bills get paid at Bank of Canada, and funds might travel here. So thank you very much.
All right, we have roughly 10 minutes for Q&A. So Lucas, I don't know if you want to start with any reply to your discussion, or if you just want to take questions and come back here. For the people in the very back without the mic, we do have a moving mic, and Jesse is nice enough to go around and bring it. For everyone else, remember to turn on the speaker button when you speak. Lucas, come back up. And if you have questions, just start raising your hand, I guess. Rod, there you go.
I think I can, maybe I can start with King's comments then. So the 200 reais bill, I haven't seen one. I went to Brazil several times since, but I maybe, but I don't see like people using it. The Fonseca paper, you're showing the graph there, but stops in 2015, right? And what we show is that since 2015, what happens is that there is a 20% decrease in the number of branches. So we see that there is like a negative trend there. I think that negative trend accelerates even more after that. But I agree that we can look the history in 2004. The relevant market, I think it's a good point. But if we imagine that the relevant market is a bit bigger, all the results that we see there, they're going to suffer some attenuation bias, right? So there are spillovers that are local. They are going to also affect localities that are close to the places that we use. So what would happen is that our effects would be even bigger. But I think we can do that for sure. The ATMs, most of them, they're inside the bank branches. So it's very like, there are some that are outside the bank branches, but we try to collect that information. One thing that the Brazilian Central Bank has like some amazing data, but they don't have, for example, cash withdrawals. They don't have the amount of cash in the ATMs. So this is something that we try to get, but we didn't get. Some central banks have it, but not the Brazilian one. Thank you for the discussion.
Yeah, so just a couple of questions. One is I didn't quite understand why banks needed to be rational. I thought you were using this as sort of an exogenous event that's not correlated with other activity in terms of the use of cash and so on. And then secondly, so we obviously don't want to encourage bank robberies, but in terms of policy recommendations, would you go so far as to say that these results suggest that policies that in some sense hinder the use of cash are good policies?
I think I can say it's hard to say the external validity of this, but what happens in Brazil is that we have this very concentrated market in traditional banks, right? And we have these huge fintechs, like so for example, one of the fintechs now is the second largest bank in Brazil. So it was this cash dependence, this decrease in the cash dependence could be a good way to increase the competition. So I think it's more about like let's digitalize the economy. Now we have different players. Different players are able to enter the market, and that's a good thing, right? It would be increase the competition. I'm not saying that let the robberies happen. It's just that let's digitalize the economy, and this eventually is going to happen, right? About the rationality of the banks, I think if we just run a regression on where banks close the branches, we would have something that would be a mixture between the decision of the bank and the effects of like closing down the branch, right? That's why we use the shock. So the shock is like is about getting like a kind of exogenous change in the branch presence. I think when King was like discussing here, he was thinking more about the rationality of the people, the criminal organizations, right? we present this paper, for example, for game theoretical people, and they were like, that's fine. What you find makes total sense, right? You need to play mixed strategies, otherwise the police is going to know where you're going next, so you cannot do that, right? So it needs to be like some kind of rationality on the side of the criminal organizations. They are quite sophisticated, so I think it makes sense. I think they need to have this. If they make it easy to the task force, now the number of these attacks is decreasing because now we have a task force that's really like able to deal with that. The numbers are still high, but they are like 1/3 that they were in 2018. So, yes.
Okay, I think I've got this for you. I'm a little puzzled by the credit results that you have, and I don't know anything about the industrial organization in Brazil, but in the U.S., certainly for credit cards, and it's becoming the case for mortgages, the credit allocation decision is pretty much independent of what's happening with deposit gathering locally. And so is the mechanism that you're describing a liquidity shock at the level of a bank branch, or if not, what is the mechanism?
So the mechanism that we propose here is that imagine that you are a client and you need to make the decision on which bank you are going to use, right? You can choose between the digital or a physical branch, a traditional bank. The cost of getting cash, the cost of making payments is much lower if you use a digital bank now.
So what you're saying is the consumer moves all of his or her business to a digital bank in response to a cost shock.
Exactly.
Yeah, okay, got it. Thank you.
Yeah.
Yeah, I wonder what your shock is identifying. There are two different things that might be happening. One is the availability of cash itself. The other is increasing perception of costs of using cash due to robberies. Right? And you suggest that it's the former, but is there any way you can discard the latter? That is essentially what especially the persistent effects that you show could be happening because people are now more aware, especially in the treated regions, that there's more potential for robberies, that increases the fear and cost of using cash.
Yeah. So the way that one of the tables that we have there is like the number of alternative branches that you have at the local level, right? So our argument there is that imagine that's just fear to go to the branch, to a bank branch, or it's just that you don't want to have any cash with you because people are going to rob you, right? If this is the case, we would not see any like heterogeneity in terms of localities which have more or less bank branches to withdraw cash, right? What we show there is that if you have more than 4 bank branches at the local level, what's going to happen is that the effect on the technological use is going to be basically 0. So we think that the explanation here is that if you're still able to get some cash at a lower cost, you are not going to be affected, and it's not the fear itself, otherwise this mechanism would not be there.
So ignoring the clear implication, at least, that the payment system operator should be subsidizing bank robberies, in the middle of your sample is a big exogenous event, the COVID-19 crisis. How are you controlling for that? I mean, that's had large behavioral impacts on many things, and curious whether there's any part of that needs to be adjusted for here.
I think that's an excellent comment. I think the first part of the paper that we are dealing on the effects, only on the effects on the adoption. What we do is that we did not have that on the paper. On our first submission, we had there are 2 talking about COVID, but what we can show is that there is no correlation between COVID and the robberies. So these shocks are orthogonal to COVID. If a robbery happens, this is not going to affect COVID. once we talk about the second part of the paper in which we compare the effects before and after COVID, I agree that part of that effect is due to the fact that people now, they might be using some digital methods just because during COVID they were not able to get, to go to the bank branch, right? Part of those effects, I agree that could be driven by the COVID, and we are very careful on writing about that on our results. But I agree with you that this could, that at least the second part, it could be that some part of that is driven by COVID.
So you discussed that there is no correlation of this type of crimes with homicides, but did you check if there is a correlation with non-violent crime? Because I can see that if in locality you have a lot of robberies, people don't want to carry cash with them, and they would like PICs, and they would use PICs because of that.
Yeah, if we had that information, it would be great. Brazil, we just have the only crimes that we have reliable data that we could really trust is homicides. All the other data, the way that you need to report that is very different at the city level, so we cannot have information at the national level. That's why we focus on homicides, just because it's the only data that we have reliable at the country level.
This is actually our last question. We need to move on to the next session after this. Thank you.
So, thank you very much to the organizers for including this paper on the program. This is joint work with Kim, who just gave the discussion, and Alex, who's listening in remotely, and we're all at the Bank of Canada, which means I need to again state the disclaimer that the views expressed here are mine, and mine only, and should not be attributed to the bank's governing council. So what do we do in this paper? As the title suggests, it's about cash and cash inventories and cash use. So no bank heists, unfortunately, but I hope it's interesting nonetheless. All right, so I want to start the motivation by just making 3 observations. The first one, and I think in this audience I don't need to explain that too much, is that we see a lot of rapid technological developments in the payment industry. New payment instruments become available. But the key part is that even though they're increasingly adopted, consumers mix very much what they have, and some payment methods like cash in particular still are fairly resilient and are still continue to be used by the populace. So cash usage has been declining, that's an unambiguous fact, but it retains a sizable market share, in particular for small value transaction, and continues to be used at the point of sale, at least in Canada, and my home country, Germany, we don't even need to talk about. One interesting facet that I won't spend too much time on today in the presentation, but that we touch upon also in this paper is the cash puzzle, where even though cash continues to be used less and less at the point of sale, the number of notes in circulation and value of notes in circulation is actually rising. So a natural question there is, to what extent is that driven by the preferences of the people and changes in the infrastructure and so on. And that already brings me to the last point, which is this infrastructure of access to cash. It is changing. In Canada, for example, we see a reduction in bank branches nowadays, but a corresponding increase in the number of cash access points in the form of ATMs. In other countries nowadays, you withdraw your cash not in an ATM or bank branch, but you get it back as cash back when you buy groceries. That's how I used to do it back in Germany. So what we want to understand here is who are the winners and losers from these types of changes. And to do that, we set up a model, a structural model of dynamic cash inventory management. So it's a Baumol-Tobin type inventory model that we related to, that explicitly accounts for the payment choice where we mix cash and non-cash means of payment at the point of sale. We then estimate this model using multiple waves of detailed diary data that we gather and assess at the Bank of Canada. And we explicitly want to incorporate the changing infrastructure that we see in terms of the access to cash. How can consumers, in fact, withdraw it? We speak to the cash puzzle. Again, I'm not going to go to that too much today, but we can quantify here kind of the domestic usage component. How much of the change that we see of notes in circulation can be attributed to the motive of holding it at the point of sale, relative to, for example, foreign demand or store of value considerations that are the things that we are not capturing in our model. And finally, and that's the thing that we're working on more recently, and for which I also have to apologize to John for a relatively rough draft of the paper, is that we want to explicitly account for consumer heterogeneity. So one of the key questions we have is when we typically estimate these models, we group consumers by relatively broad demographic groups, And we're going to try to estimate preference parameters for these broad groups as a whole. Now the question is, are we missing something there, or are these kind of average effects that we estimate in fact understating potential bimodalities in the response? So here we want to contrast one type of this representative consumer approach with a fully flexible estimation approach where we try to back out preferences at the consumer level. And one of the things we find is indeed that in response in the counterfactual changes to the cash infrastructure that we see is in fact bimodal. It's not that all consumers behave the same, but some of them, even though all reduce their cash use, reduce it only a little bit and instead withdraw less frequently larger amounts and continue to hold them. So to that extent, domestic usage component actually accounts in part for the increase because consumers just withdraw more often. Sorry, more money less often. And then we have another part of the population that says, well, if you make it harder for me to use cash, like in the context of your paper, I just stop using it entirely. But this bimodality is important to account for because for us as the currency department at the bank, one of our provisions is to ensure that people can use cash if they want to. So just looking at the average effect doesn't do it justice because we need to focus also on that subgroup that wants to use it and continues to use it. All right, so I'm going to skip the literature for time constraints, except for noting that there are people in this room who have, of course, extensively contributed to it. And I want to start with a brief overview of the model in terms of the parameters of interest that we're going to be estimating. And I want to stress here that this is really very much a parsimonious model, so we're going to try to structurally estimate it afterwards. Some shortcuts we unfortunately have to make, where, for example, our elasticity preference parameter for cash that we're going to have, that's denoted alpha, that captures how much do we want to pay with cash versus non-cash means of payment, debit, credit, mobile payments, is going to encapsulate not just the intrinsic preference for cash, but also, for example, other constraints, such as we can think about credit limits. We can think about, do the merchants on the other side accept it? All of that is kind of here lumped into these preferences, and we need to take that into account when we later on interpret the results that we have. We also have a second parameter of interest, which are the holding costs, and that's just the security, the foregone interest. If I carry cash in my wallet, it might get stolen. No, I'm not vulnerable to the bank heist because it's me as a person, but a robbery can in principle happen. I can lose it. And of course, in the current climate, also interest becomes again a relevant factor. By carrying cash in my wallet, I'm not going to earn any interest on it. And finally, we have the cost of withdrawals, and there within the model, it's decomposed into two factors. One is the actual distance to cash access points. We know that shoe leather costs are important when it comes to withdrawing cash. So depending on how far I am from cash access points actually matters, but that's not the only thing. Because on top of that, people very much differ in how willing they are to walk that distance, to go the distance to withdraw cash. So there's the one component that is unaffected by individuals, which is the actual physical distance to the branch network, which is the measure we're going to use. But on top of that, there's individual, potentially individual heterogeneity in terms of how much these people are willing to go. All right, so let's go to the model. We have a discrete time setup, and individual consumers want to, in the end, make transactions at the point of sale. And for that, they, in each period, have their cash inventories, which is the cash left in their wallet from whatever previous period that is. In the empirical implementation, a period is going to be a day. In that period, they face an exogenous consumption demand that has a random component, so that evolves over time. And they choose how much of that consumption demand on that given day they want to make in cash, and how much of that they want to make in non-cash. Now, to facilitate cash payments, they can use the cash in their wallet, but they in addition have the opportunity to withdraw cash, but withdrawals incur a fixed cost, where this fixed cost reflects both the distance to the branch network that we take from the data, and a scaling parameter that that is different depending on the individual consumer or on the consumer group, depending on how we estimate it. We have a variant with deposits that I'm not going to talk about, and I don't want you to focus on the math at the bottom, but really more on the intuition behind what we're going for. So what do consumers do? They maximize the discounted sum of flow utilities that they get from mixing between cash and non-cash means of payment for transactions at the point of sale. And the constraints that they face in each period are the following. Number one, the amount to which they use cash is non-negative, and at most they can use as much cash as the combination of what they have in their wallet and what they withdraw in addition on that day. They cannot use more cash than the total expenditure. If they buy something for $200, they're not going to leave $300 at the table, even with the current tipping culture that we have in North America. Withdrawals need to be non-negative. Again, deposits are in principle something the model can easily account for, and we need to stipulate some sort of initial condition at the beginning of the entire model, but that doesn't matter that much. For the flow utility, we use the log-transformed conductless that again has three components. The one is just the flow utility from making payments, and again, it's just from making payments, not from the actual consumption. And here what matters is I want to use cash and non-cash, and the elasticity between those two, what captures the preferences, is this parameter alpha. The second thing is that I have the opportunity to withdraw additional cash to facilitate cash payments. But if I do that, if the withdrawal amount is positive, then I incur a fixed withdrawal cost, and that withdrawal cost reflects both the individual level scale of it and the distance to the branch network. And finally, whatever cash I have in my wallet at the end of the period, at the end of the day, I face this holding cost, which encapsulates things like interest, security losses, and so on, and that's the parameter gamma. Now, we can write this model in recursive form as a dynamic programming problem. And again, what's not so important here is all the details, but the key observation is that anything I do today in terms of withdrawal behavior and cash use matters for my continuation value, for what happens in the future, only via pinning down how much cash I take into the next day. So if I have $200 in my wallet at the start of the day, tomorrow, it doesn't matter what I did yesterday. Did I start with $300 and spend 100? Did I start with 100, withdraw 200, and spend 100 of cash? None of that matters for my value moving forward. Now, why is that important here? Because it allows us to recast the entire problem. We can take as a choice variable how much cash do I want to have in my wallet into the next day, and use that to find the optimal way of facilitating that by finding the combination of withdrawal and cash use that maximizes my flow utility. Now, how does that choice look like? So in a given period, I now want to choose, which you have on the x-axis, my change in cash inventory. How much do I change from what I start the day with to what I want to have tomorrow morning? And on the y-axis, I have my cash use C and my withdrawal W. Now, there's going to be 4 regions here. The first one is just what's infeasible. I can rule anything out of reducing my cash holdings more than the cash I started with or my expenditure that day. Again, if I start with $200, I can't reduce my cash holdings by $250. If I spend $200, I can't reduce my cash holdings by $250. I'm not going to set the money on fire. And baseline model does not allow for withdrawals. The second region is the one where I actually increase my cash holdings. Now, the only way to increase my cash holdings is by actually going to the ATM, going to the bank branch and withdrawing cash, which means given that I withdraw anyways, that I incur that withdrawal cost anyways, I may as well implement my desired level of cash consumption C tilde and just withdraw exactly the amount that makes it so that I can use my optimal desired level of cash and withdraw exactly enough to match whatever I want to take into the next day. The third region is the one where I want to reduce my cash holdings by more than my desired level of cash usage. So suppose I want to ideally spend $50 in cash. If I had the free choice, I want to make $50 in cash and $50 in non-cash transactions. But my goal is to reduce my cash holdings by 75. Well, the only way I can do that, or the best way I can do that, is to just exactly spend those $75. Because what's the alternative? The alternative is to withdraw some money and distort my cash use level even more, which of course yields me a worse flow utility. And it might sound weird to have this kind of behavior, but I actually don't find it weird, because if I think about it, sometimes it happens if I get, for example, a cash present, Christmas, grandparents, that tends to happen. I have more cash in my wallet than I want to spend, so even though I suddenly do transactions by cash that I would normally do by card. And that's exactly the kind of idea that's going on. And then finally, I have a third region, which is the one where I want to lower my level of cash inventory, but not by as much as my desired level of cash consumption. And then I have 2 choices. The first one being that I lower my desired level of cash usage. So if I want to reduce it by $25, but I have 50 as a target level, well, I can either just use less cash than I would ideally want to, or I can use exactly the $50 I want to, but then I need to compensate for that by withdrawing some. And how I resolve that trade-off is, of course, going to depend on the fixed cost of withdrawal, which matches both the individual preference F and the distance D. Okay, So that's what happens in period. Key observation is, you tell me how much you want to carry forward into the next period, conditional on what you have today, and it's going to uniquely pin down exactly the combination of how much do I withdraw and how much do I use at the point of sale. So that means we can now rewrite the entire problem as a Bellman equation where the current cash holdings are the state variable and the future cash holdings the control. That's going to pin down my flow utility by solving this optimal behavior that I've just outlined. And then we can now focus on estimating this value function. How do we do that? How do we take that to the data? Conceptually, we first need to make this choice. We need to characterize it. So we approximate it by taking a 6-month planning horizon, but we're robust to any perturbations there. That gives us the value function. Given the value function, I can use any holding level, any consumption level that I have in that period, and back out what am I going to withdraw, what am I going to use, pay for in cash and non-cash. And what I just want to stress here is that the implied behavior that we get from that, which is a nice verification exercise for this approximation, really is in line with theoretical predictions. So what triggers cash withdrawals, either if my cash reserves are depleted, or also if I need to spend more on a given day, because that is associated, based on the utility function we have, with a higher desired level of cash use. So one way to facilitate that is, of course, to withdraw more cash. All right. So now let's talk about actually fully taking this to the data. As I've already said, we use detailed survey diary data from the method of payment surveys that we run at the Bank of Canada. So specifically, we have 3 waves, 2009, 2013, and 2017. For each of those waves, we have 2 pieces of data, a survey questionnaire that includes a lot of demographics, including the location of people, which is something we're going to exploit for this distance measure, distance to the branch work at their local level. And then we have a 3-day diary where consumers record all transactions they make at the point of sale. Now, one thing I want to emphasize here is that there's many different empirical and theoretical works on cash inventory. Here, we really aggregate by day. So we do not estimate for each individual transaction, are you going to use cash, credit card, or debit card? But on a given day, given your overall consumption on that given day, how much of that share do you pay for in cash versus non-cash means of payment? We need to, for that, of course, get at the consumer's spending types. And empirically, how we deal with that is by saying, well, we take the consumers, we group them into 30 relatively broad groups that then have an average consumption per day, total expenditure, SI, and then the empirical variation that we see for these 30 groups at that average allows us to get at the variation that they face from a day to day, which of course is important because one motive for holding cash is precautionary, for example, needing to spend more because my consumption over the day is more. Again, spending type, only total expense, it's not how much they use cash. The distance we get from the data as well. And our distance measure that we use here, and for time reasons I'm not going to go into too much detail, is the inverse density of bank branches. So we take the consumer, we look at the forward sortation area, that's a mailing system, postal system based measure. We have about 1,500 of those in Canada. We count the number of bank branches in that area, and we relate that inversely to the distance of that forward sortation area. So that gives us a measure on average, how far are consumers in that FSA away from the bank branch network. Now, why do we focus on bank branches? In the period of time that we have there, they in fact account for the vast majority of cash withdrawals in Canada. So white label ATMs, small proportion, and ATMs owned by banks, in fact, are co-located with bank branches more than 80% of the time. So this really accounts for a lot. Nonetheless, we do have ATM data, and we're working on incorporating that. All right. So what's the estimation procedure? We basically use the data to obtain the empirical moments about consumers' purchase behavior and cash use. So I've already talked about the expectation of the total expenditure SI and the variation. We also can get from the data that we see how much do consumers withdraw conditional on withdrawing cash. What's the probability that they withdraw on any given day? What's the unconditional expected cash holdings, meaning how much cash do they hold on average per day? But also how much do they hold following a withdrawal of cash or right before withdrawing? Either one of those we see. The problem there is, and that's important for some of the results and what we're working on, we here have relatively frequent missing observations. So this is one of the data moments that we can use or not use, and I'm going to talk about that later on in the robustness, and where we're still also looking at exactly assessing which way we want to take the paper forward. And then we have the expected level of cash consumption, how much cash do consumers per day. Now, this is what we see empirically. On the model side of things, if you give me any set of these three parameters, cash preference alpha, holding cost gamma, and withdrawal cost f, together with the distance that that person in that moment in time has to the branch network, then I can use the model to forward simulate it and compute the predictions that I draw from the model, which is also about the cash usage, the cash holdings, the withdrawal probability, size, and what's the holdings when they withdraw. So I can now compare what does the model predict with what I see in the data to obtain these prediction errors. And then I have two ways of now estimating the model. One is representative, where I group consumers into relatively broad demographic groups and assign the same preferences to all of them, and then estimate which preference for that group best predicts the data. And the other one is an individual-specific approach, where I really try to back out preferences on an individual consumer level. Both of them use a nested algorithm where I solve the dynamic programming problem, forward simulate it, and then obtain the errors. But now I either stack for each group the vector of errors and weigh them according to a standard two-stage optimal weighting matrix, or I do the fully heterogeneous approach where for each consumer, I look for the preferences that best predict that consumer's behavior. And here the criterion I use to evaluate that is just to minimize the average squared errors of these 5 moments that I had on the previous slide. Now I want to stress here 2 things. First, alternative ratings are straightforward to implement. In particular, for example, not matching the holdings at withdrawal, where we have a lot of missing observations, and where, for example, the optimal weighting matrix from the representative approach assigns it comparatively little weight for exactly that reason. Another thing that we can do here and that we're working on is to move towards these, what the literature has done in the past, and actually obtain a full Bayesian posterior distribution of all types of preferences relative to how likely they are to explain that particular consumer's behavior. Again, work in progress because it's computationally somewhat extensive, and our high-performance computing can only handle so much at any given moment in time. All right, so let me now talk about the results. First of all, just to give you a broad overview, what do we find? So I've got here in the odd columns what we get from the heterogeneous consumer-specific approach, where I, for each of the 3 parameters of interest, give you the average, the median, and the standard deviation of what we find. And then I contrast that with the even numbers, even columns, where I have the representative approach, where I really just pool the consumers either across the entire sample or by year that we observe them in. And what I want to first show you here is that the median estimates from the heterogeneous approach are in fact qualitatively very similar to the representative approach, at least for the cash elasticity alpha and the inverse cost gamma. There's substantial variation within them, but the median is actually doing pretty well in terms of matching it. That's not the case for the cost of withdrawal, the individual specific parameter that reflects how consumers interacted with the distance they physically face, dislike withdrawing cash. So there we have substantial differences, even though the qualitative patterns seem to be somewhat similar in terms of the trend. Now, this substantial heterogeneity, that's something I want to stress, is really, really important in many dimensions. It doesn't go away if I control for additional demographic factors and don't just estimate on the entire sample, but for example, group them by age, by income, by further things. We've done all of that. We still will always have a substantial variation in what consumers individually behave as. There's big differences even if you take a German my age who lives in Canada. Not all of us are going to use cash the same way. Not all of us are going to withdraw cash the same way. And that might seem funny or laughable at first glance. It's an obvious statement, but it actually has profound implications when we later on go to the counterfactuals. This is just to further illustrate the heterogeneity, so I don't want to spend too much time. But again, we see for the cash preference a relatively smooth distribution. We really have some people, quite a lot of people who don't use cash that much, but we also have a few who do all their transactions in cash. Whereas for the holding cost and withdrawal cost, it tends to be a bit more bimodal, or rather exhibits a long tail. We have a lot of people who have relatively low costs for both of them, but then there's some people who really dislike having cash in their wallet, or who really incur a substantial cost on going on top of the already physical distance that they cannot affect. The model fit, unsurprisingly, is much better if we try to match on an individual level. And again, all I want you to take away from here is this persists even if we use the representative group approach on smaller and smaller groups. We have consistently lower absolute prediction errors if we estimate it on an individual basis. Before I go to the main part that I want to talk about today in terms of takeaway, I want to summarize two other things because they're important, I think also in part because John might pick them up in the discussion, but because I think they are important for us also as a policy-making institution that is worrying about cash distribution. So the cash puzzle I've already alluded to. We see cash use at the point of sale on average declining. We see notes in circulation increasing. What we can use the model for is to understand how much of that is due to the domestic usage component at the point of sale. And what we find there is that this domestic usage component does relatively well in explaining the increase between 2009 and 2013, in that we can rationalize about 50% of the increase of notes in circulation in terms of value via this demand for banknotes to conduct transactions. After that, it differs depending on which approach we're using, but at most we're accounting for about 30% of that further increase. And this kind of lines up with anecdotal evidence in the case of Canada specifically. I don't want to generalize that to other countries, where during that time post-2013, foreign demand has really increased a lot more relative to the time previous. And again, important for us because we're charged with distributing the banknotes, so we need to understand where does the demand come from also to forecast it going forward. The second thing I've already said, we repeat the estimation and comparison by broader demographic groups. Heterogeneity continues to matter. But what I want to do now in the rest of this presentation, and I think I have about 7 minutes, is that correct? 5, okay, I can do that as well, is to talk about what's the counterfactual response if we change the infrastructure further. So we see some changes in the data as we currently use it. But going forward, we have seen a reduction in bank branches in Canada. Suppose it's, for example, one of the last bank branches in certain regions. That's something we worry about quite a lot. But even more generally, how are consumers affected? And how much does this effect relate to this individual heterogeneity that we have? So for that, we do several exercises. The first one is that we compute an elasticity of how do consumers respond to a change in withdrawal cost. And here we're going to take an extreme one, 100%, meaning we go from 50% of what they actually face in the data to 150%. And we look, how do these predicted moments that the model generates vary if we undertake that counterfactual change. And then we can also look at how these predictions that we get relate to demographic covariates that we observe in the data. Now, what do we find? First of all, unsurprisingly, we have sizable heterogeneity on an individual basis in terms of preferences, so we're going to have a sizable heterogeneity and on an individual basis in all dimensions when it comes to the model-generated moments. The first thing is that the overall consumer welfare that they estimate doesn't drop by all that much for most consumers, but the changes that we do see are concentrated in 10% of the population. Now, unless we take a utilitarian approach where we weigh everybody equally, which is not the mandate that we have, that's something that is potential cause for concern and further investigation. So it's a concentrated welfare impact. The second one is, unsurprisingly, if I make the counterfactual change of making withdrawal more costly, people are going to withdraw less. Anything else would have been very problematic for us. What's interesting, though, is that we identify two types of adjustment strategies, how consumers respond. So they withdraw less, but what do they actually do? Well, there's one group that drops their cash use. Withdrawing cash is more expensive in terms of the utility loss that they incur when they need to withdraw. So they use it less often at the point of sale, they withdraw less often, and they withdraw lower amounts. That's perhaps the prediction that you would have expected. I make something more costly, so I use less of it, and the rest follows. But the second one is that there's a sizable population of people that in fact do not alter their cash use by a whole lot. Instead, they economize on withdrawals by making them less frequently, but by withdrawing larger amounts, they actually increase their cash holdings, they actually increase how much they withdraw. So they can afford to actually hold more cash and to still withdraw it at least somewhat frequently. So they don't want to alter their use at the point of sale, and they don't have to, because they can, in fact, afford to do it. And this affordability is actually something that we see when we relate it to the covariates that we see in the data. So here's just a simple comparison on the left side for cash holdings, on the right side for the withdrawal amount. What are the estimated parameters, but also what's the age, the income, and the revolver status? Do they carry balances on their credit card or not? Of these consumers, depending on their adjustment strategies. And on the left side, which is what I want to focus on right now, is Who increases their cash holdings? It's people who are older, more affluent, and less likely to be a revolver. So it's really, these are people that can afford to, in fact, continue to use cash, despite the fact that our preference, which again encompasses other factors, is in fact lower for them. So the people who actually want to continue to use cash cannot, because they're priced out of the market, so to speak, if withdrawing cash becomes too expensive. The final exercise, and then I conclude, is we can trace out an entire response of what happens if we counterfactually vary the cost of withdrawing cash proxied by the distance from 0 to 200% of the measure we observe in the data. And as expected, if withdrawal cost goes up, consumers withdraw less and use less cash. And you will see that already a relatively small increase of about 30% in withdrawal costs would be sufficient to stop 25% of consumers from using cash, using PICs, using electronic transfers, using other means of payment. However, we again see this bimodality in responses in that if I compare the distribution of responses in terms of the cash holdings, well, you will see that on average, people, as withdrawing cash becomes more costly, tend to hold more in the beginning because they want to withdraw less often, they want to use it at least somewhat. When it becomes too expensive, then the path splits. There's the people who stop using cash, so they don't need to withdraw, they don't want to withdraw, they're no longer going to use it. But then there's the others who continue to use it and do so by withdrawing more and more cash and correspondingly holding more and more cash. Okay, I'm going to skip the robustness and next steps and just conclude. So we present a structural dynamic cash inventory model that has a trade-off between more frequent withdrawals and larger cash holdings, as is common in literature, but allows for people to mix between cash and non-cash and accounts for the infrastructure affecting the cost of withdrawal. We estimate the model, and one of the key takeaways I really want to have is that average responses, all well and good, but they're really the substantial heterogeneity that we see needs to be accounted for because it leads to very different responses. Even on average, we don't see much movement. It might in fact be that just half the people move there and half the people move there. Thank you very much, and I look forward to the discussion and questions.
Andre gave an excellent presentation, and I really enjoyed reading the paper. I think it's very cool. But I have to do a disclaimer. I'm a micro guy. Last time I had any macro was at MIT. It was taught by Larry Summers and Bob Litterman. So just as a check, cash is part of M1, right? Is that, okay. All right, so I'm not going to come across as an expert in this area. I think maybe they chose me. I worked on inventory models, but inventory of steel. And I used to teach at Yale. And another person besides Ballmer and Tobin is Herb Scarf, and he had the SS rule, right? They have a big S and a little s, and when inventory goes below little s, you give up to big S. And those kind of models, we've generalized them for steel, and they're rejected. In other words, steel guys, and it was called the steel service industry, these models don't really work well for explaining their behavior. Now, what about cash? One of the papers they cite is a 2009 econometric article by Fernando Alvarez and Lippi using Bank of Italy data. And it is in the spirit of what they're doing here, but that model got rejected resoundingly. They were looking at the effect of having ATM cards in Italy, and they showed it made a big difference. People who had ATM cards had less cash, went to the bank. So it's really in the spirit of this. But this paper, their paper really kind of blows Alvarez and Lippi out of the water. So by transitivity, this paper should get into econometrica. It's a very clever paper using, with a very clever way of integrating spending with a kind of a Cobb-Douglas utility function. So, Andre did a great presentation. I don't want to, basically repeat it. But maybe, can I see my slides here? And
Apologies, we're having 1 second of technological issues.
Okay. Okay, so let me just say, it's always easy to criticize and talk about other people. When you do these structural, it's a lot of work, and they did it, just right. I mean, and you start simple. They don't have all, it's easy to look at a model and say, what about this, what about this? And so I'm gonna do a lot of whataboutism, right, in my comments. But, the reason we do this, we push, is that to understand payments and the technology, we have to push these models beyond and say, what more can we do? So, so when I read this paper, not being an expert in this literature, first thing that came into my mind is, hey, why cash? Well, this isn't cash going like the horse and the buggy? Now they work at the Bank of Canada. They're responsible for producing, making sure there's enough currency in the hands of people. So that's one, but then I wonder, why a structural model? This is kind of a very simplified structural model. Wouldn't like a more macro time series be better for doing that on a practical basis? Now, I think one answer is that Bank of Canada is trying to promote science, and we want the next generation of models, and just using off-the-shelf macro forecasting might work well for today, but you want to say this is a generation of models that goes to the next generation. Now, where would that next generation be? So this is where it's easy for me to kind of dream big. It's harder to actually get it done. It's hard to get the data. But the key shortcoming of their approach is the lack of detailed attention to other transaction technologies, right? We have myriads of them now, and the first paper talked a lot about that. This really cool, what's called PIX in Brazil. In Sweden, it's Swish. We have Apple Pay, right? Debit cards, credit cards. And those are all lumped together in all the above, and cash, is getting small. And the way they capture cash is very interesting. It's a very clever way of doing it with this Cobb-Douglas parameter alpha. But I remember when I was taught macro, big no-no is putting cash into the utility function. So essentially, they're kind of putting cash into the utility function. But, we all do that, right? We kind of confess our sins. So a deeper model wants to kind of endogenously explain why would someone use cash, okay? So, cash is just one way of paying for stuff. So to really understand why people use cash, we need a better model of the costs and benefits of different payment technologies. And revealed preference shows that people prefer to use their iPhone, right? You go, bing, there's your payment, right? And that's just so much cooler, so much faster, and cash is kind of dirty. Now, why do I, if I look in my wallet now, I got about $3 in my wallet. I actually try to have more, it's kind of robbery money. The reason I have cash is in case I'm robbed, I don't want to be shot, so I want to give them enough money so they don't get angry and shoot me, okay? But now I can even buy hot dogs with my credit card, right? So why have any cash except for maybe some kind of precautionary motive? So let's go to the next one. So I think there's, describe a chicken and egg problem of cash use, which is, what you use as a transaction depends on what merchants choose, right? And if if the hot dog guy only takes cash, I need to have cash if I want to buy a hot dog. But if they take Apple Pay or some other means, I'll use that instead. But then, the merchants are thinking, what do the consumers have? Do they have Apple Pay? Should I have Apple Pay or should I use Square, right? So there's a coordination problem in determining. So you have, really you need an equilibrium model. We have merchants on one side, consumers on another, and look at the equilibrium that results with technological innovation. Well, that's really, really hard. So, and that's a chicken and egg problem that could have multiple coordination. It's a coordination problem, could have multiple equilibria, kind of self-fulfilling expectational equilibria. Now, it has been studied before in a kind of famous paper by Kiyotaki and Wright in 1989, Money as a Medium of Exchange. And, here's a quote from their abstract, that you can get multiple Pareto ranked equilibria. They're not Pareto optimal, and but that means there could be a role of a government for improving, or some kind of regulator for selecting a better equilibrium in these situations. Now, so then, relative to why this conference is the Fed, is what's the role of the Fed in all of this, if you think about that? Can the government help us find a better equilibrium and reduce transactions costs, fraud, and promote stability of the financial system? And now, these days, we're talking about technological uncertainty. I mean, massive communication breakdown. If we go to eCash, which is really cool, but it's got vulnerabilities, strategic, like could the Russians crash our system and crash our economy in an instant? So cash might not go away because we want some security as you know, a medium of exchange when all the networks break down, okay? So now, Bank of Canada has a website and they're talking about CBDC, right? Central bank digital currency. I think it'll be probably talked about here. The question is, that's a hot button topic here in America, right? You know, should the Fed even go there? I don't know. I don't think the Fed might be going there, but there's a Cato Institute right not a few miles down. They are saying, don't go there. Don't go there, man. Stay away from this, right? So to give a sense maybe of their concerns is, you know, I like to joke, would I buy CBD using CBDC? And the answer is probably not. You know, I want the Fed looking over my shoulder. So you know, I think they're almost paranoid there. I think there is a role for the Fed, but you have to tread very carefully, I guess. You know, we're in Washington, it's realities. So the rest is, I want to just talk about this cash puzzle. And I'm just going to go through, first of all, I found the Fed data, so I'm going to show you some slides just to, you know, educate myself, showing the decline of cash in the United States. And the Fed has excellent stuff online. You can just go and see a lot. This is Goldman Sachs stole some stuff from the Fed, and I'm stealing it from them, okay? And then here you're seeing the decline of cash over time. So, you know, this is stuff you all know better than I, but I like this graph right here, though. I am a small business owner. I have a little company called Techno-Luddites, and you know, we get a lot of our money from come from merchants. We bill people using PayPal, and it's expensive. It's our third largest expense. And I'm thinking, collecting money, should it be that expensive? It's outrageous. I'm paying 4 or 5% of my revenues to PayPal just to collect and deliver the money. Now, whenever I can, I want ACH. Thank you, Fed. I love the ACH. I'm getting money for free. It's the cheapest, fastest electronic system we're on. Why isn't that expanded? I would love just to use it on my phone. Bam, ACH. You know, why Zelle? Why Venmo? Why not ACH transfer with your cell phone? So as a small business owner, I'd say, please expand the ACH. Do that. But again, you're competing with PayPal. You're competing with big political interests. So obviously there's political, you know, this is above my pay grade, as they say. You know, you basically see also this is a San Francisco Fed graph, another really great report, and shows, you know, cash is really being abandoned by the young, especially. The old people are old fogies, but even they're reducing cash, but the young are especially moving away. But it is an inferior good, right? So poor people have to use cash more, and partly because poor people are unbanked. So if you look at here, banked versus unbanked, the people who don't have a bank obviously have to use cash a lot more. There was a very sad incident this summer. I was teaching at Howard University, and a construction worker was killed because the construction workers get paid on Fridays in cash. The robbers know that, and a robber went over to construction, demanded the money, and he unfortunately fought to keep his wallet, and he got shot and killed. And you know, so, but probably, you know, in some cases you're an illegal worker, not a documented worker, and they pay you in cash kind of under the table. It's a black market economy. Now, so here's the point I'd like to kind of close on a little bit. There was no precautionary motive in their model, and that could be a big part of the cash puzzle. People hold cash for a number of reasons. You can see how it went up. This is US data, the green lines. It went up a lot during COVID, so people probably were worried about it. But Canada had, last summer, had Rogers Communications went out of business for like a day, and like 10, 12 million people couldn't transact over that day. And so there's evidence that in Canada, people actually responded by more precautionary holdings of cash because of these transactions problems. So, and Sweden, you know, has Swish, right? They're moving to very close to cashless society. But the Sweden, you know, when Ukraine got invaded by Russia, they were worried about cyber attacks, and the government said, hey, maybe you should withdraw some cash, some kroner, and keep it under your bed just in case. Well, so my closing point is, would it be possible to make a digital cash that wouldn't be vulnerable to cyber attack, like using near-field communication like Apple Pay? When it can connect to the internet, it can verify I have valid cash, but I have a digital wallet. But if the internet goes down, I can still beam money from my phone to your phone, so we can continue to work. And then I can have precautionary digital cash right on my phone and use that. So I'll just, it's way a bit above my pay grade, but you know, I'm asking, maybe there's really good answers, but I'll shut up from there. But I really enjoyed the paper, it made me think a lot of things.
Right. In the interest of time, maybe we could do questions during the break. We have a bit more food and coffee for you guys to keep you going. Apologies. To keep you going until lunch, since we have a fairly late lunch. But before we do that, I wanted to give a shout out to the team that produces the graphs that John was talking about, right? They're Jeff, May, and Karen. They run the Federal Reserve Payments Study in my team, and they produce fantastic statistics on the use of payments in the United States. With that, there's food and there's drinks. Let's go and keep us well fed. Thank you.